What on earth is happening in Japan right now, and why should crypto investors care? This is a question a lot of people are suddenly asking, especially those who are watching the cryptocurrency market closely and wondering why prices feel so unstable. In today's video, we are going to break this down calmly, clearly, and without panic. No hype, no fear-mongering, just facts, logic, and real market understanding. And more importantly, we will talk about whether this situation is actually a long-term problem for crypto or if it is something completely different. Welcome back to We Are Cosmic. If you are new here, this is the channel where we talk about finance, cryptocurrency, and global markets in a way that actually makes sense. We don't chase clickbait narratives. We don't scream end of the world every time the market moves. Instead, we focus on understanding what is happening behind the scenes, why it is happening, and how long-term investors should think about it. If you appreciate that kind of content, your support really matters. A simple like and subscribe helps this channel grow more than you might realize. Now, let's get straight into Japan because I truly believe most people do not fully understand what is happening there. For a very long time, Japan has had extremely low interest rates. In fact, for years, Japan actually had negative interest rates. That means large institutions could borrow money from Japan at almost no cost. And in some cases, they were literally being paid to borrow that money. This is not something average people could do, but hedge funds, banks, and large financial players took full advantage of it. Here's where it gets important. These institutions didn't just borrow money for fun. They took that cheap money from Japan and moved it into other markets, especially the United States. In the US, interest rates were much higher, normally around 2 to 3%. So institutions could borrow cheap money from Japan and invest it safely in US assets like treasuries or even riskier assets like stocks and crypto. For years, this looked like a perfect, almost risk-free strategy. People started calling this the Japan carry trade. And for a long time, it worked. So well, in fact, that many investors began to believe it would never end. But that belief was the real risk, because markets always change. What we are seeing now is the unwind of that trade. Japan is slowly raising interest rates, and at the same time, the United States is expected to lower rates. That gap, the one that made this strategy so profitable, is closing. And once it closes, the math completely changes. Suddenly, borrowing from Japan is no longer cheap. Suddenly, these trades no longer make sense. So what happens next? These large players are forced to unwind their positions. That means they need to sell assets. And when big institutions sell, markets feel pressure, stocks feel it, crypto feels it, XRP feels it. This is why Japan is suddenly being talked about everywhere in financial media. But here is the key point, and this is where most people get it wrong. This is not some surprise event. This is not a hidden bomb that no one saw coming. The market knows about this. Professionals have been watching this for a long time. And when something is known, it usually gets priced in slowly, not all at once. That's why this situation matters. But it's also why it may not be the disaster many people are claiming. In the next part, we're going to go deeper into whether this is actually a black swan event or just another example of market fear exaggerating reality, and what that means specifically for XRP and crypto investors. Now that we understand what the Japan carry trade is and why it is unwinding, the next big question is this. Is this a true black swan event, or is the market simply overreacting to something it already knows? This distinction is extremely important, especially for crypto investors, because history shows that markets behave very differently during surprise events versus expected slow-moving risks. A real black swan event is something that comes out of nowhere. It is unpredictable, sudden, and catches both investors and institutions completely off guard. A perfect example of this was what happened in 2020. At that time, global markets were near all-time highs. There was no serious discussion about a worldwide shutdown, mass lockdowns, or entire economies coming to a halt. Then suddenly, everything stopped. Stock markets were halted, fear exploded overnight, and liquidity disappeared. That was a true black swan. The situation in Japan is very different. People are talking about it openly. Analysts are discussing it. Financial media is covering it, and you're watching a video about it right now. That alone tells you something very important. If everyone is aware of a risk, then it is not a surprise. It can still be negative, but it is not invisible. And when something is visible, markets usually begin pricing it in early. This is why I strongly believe the Japan carry trade unwind is not a black swan. It is a known risk that has been developing over time. Hedge funds did not wake up last week and suddenly realize Japan was raising rates. These institutions have teams of economists, analysts, and risk managers tracking this exact thing. Many of them likely began adjusting their exposure months ago. What the market is reacting to right now is not the existence of the problem, but the severity of the outcome. Markets are emotional. They move between extremes. Some people believe this will completely destroy global markets. Others think it is meaningless and should be ignored. The truth is almost always somewhere in the middle. Markets are like weighing machines. They constantly try to balance risk and reward. If the outcome ends up being worse than expected, prices can move lower. If the outcome is less severe than feared, prices stabilize and eventually recover. That's how markets have always worked. When we look at crypto specifically, including XRP, we can already see that prices have moved down significantly. This tells us something important. The market is not asleep. It is not ignoring the problem. It is already reacting. Fear has already entered the system. Selling has already happened. This is a key difference between panic and preparation. Panic happens when something breaks suddenly. Preparation happens when the market slowly adjusts expectations over time. The current environment looks much more like preparation than panic. Another important thing to understand is that this situation has nothing to do with crypto fundamentals. There is no failure in blockchain technology. There is no collapse in XRP's use case. There is no security flaw. There is no breakdown in networks. What we are seeing is a liquidity event. Large players borrowed too much cheap money and now need to unwind. That distinction matters a lot. Liquidity events create volatility, but they do not destroy value long term. They create forced selling, not failed innovation. History shows that when assets are sold due to leverage issues rather than fundamental flaws, recovery usually follows. People often forget this, but markets do not crash because the future disappears. They crash because leverage gets removed. Once leverage clears, strong assets survive and continue forward. This is why comparing today's situation to the end of crypto or the end of XRP makes no logical sense. Hedge funds unwinding bad trades does not stop global payments from evolving. It does not stop tokenization. It does not stop institutional adoption. It simply reshuffles ownership from weak hands to strong hands. Right now, XRP has already gone through a significant pullback. That alone tells us the market has been aware of risk. This is not a case where everyone is bullish and suddenly wakes up to disaster. The selling pressure we are seeing is part of a broader market reaction to liquidity tightening, not a rejection of XRP's purpose or technology. Ask yourself this question honestly. Did anything about XRP's actual use case change because Japan raised interest rates? Did Ripple stop working with banks? Did cross-border payments suddenly stop being a problem? Did tokenization disappear overnight? The answer is no. None of the fundamentals changed. What did change is leverage. Large funds that borrowed cheap money are now forced to reduce exposure. And when funds reduce exposure, they sell what they can sell. They don't sell based on belief. They sell based on liquidity. Crypto is liquid, so crypto gets hit. This is why it's dangerous to confuse forced selling with failure. Forced selling is mechanical. It has nothing to do with whether an asset is useful or not. It is simply about meeting obligations. And when those obligations are met, the selling pressure ends. XRP in particular sits in an interesting position. It is not just another speculative token. It is designed for speed, efficiency, and cross-border settlement. In a world where financial systems are under stress, not stable, systems that improve efficiency become more valuable, not less. Ironically, macro stress is often what pushes institutions toward better infrastructure. When money becomes expensive and risk is exposed, inefficiency becomes unacceptable. That is exactly the environment where technologies like XRP and the XRP ledger make sense. People often assume that price going down means adoption is failing. In reality, adoption and price often move on completely different timelines. Adoption happens quietly, slowly, and behind the scenes. Price reacts loudly, emotionally, and sometimes irrationally. Another thing many people overlook is ownership transfer. When markets panic, assets move from leveraged players to patient investors. Hedge funds that relied on cheap borrowing are replaced by long-term holders who do not need to sell tomorrow. That shift strengthens markets over time. Think about history. In 2008, markets collapsed, banks failed, fear was everywhere. But companies like Apple and Amazon didn't disappear. Their stock prices fell sharply, but their business models survived. Those who understood fundamentals and stayed calm were rewarded. Crypto is no different. The Japan carry trade unwind does not threaten XRP's long-term relevance. If anything, it highlights how broken traditional financial systems still are. And that is exactly the problem crypto was built to solve. Now, this does not mean price cannot go lower in the short term. It absolutely can. Markets can overshoot in both directions. Fear can push prices below fair value temporarily. But temporary price pain does not equal permanent damage. Long-term success depends on whether a technology solves real problems. XRP does. It solves speed. It solves cost. It solves inefficiency. And those problems are not going away just because hedge funds made bad macro bets. They are collections of human decisions, emotions, and reactions. And when fear enters the system, logic is often the first thing to leave. Every major market event in history follows a similar pattern. First comes uncertainty, then fear, then forced selling, and finally, stabilization. The problem is that most people react emotionally in the middle of the cycle instead of thinking rationally about where they are in that process. The Japan carry trade unwind is creating uncertainty. People don't know exactly how bad it could get, so they imagine extreme outcomes. That imagination turns into fear, and fear leads to selling. This is not unique to crypto. It happens in stocks, bonds, real estate, every asset class. What's important to understand is that fear does not mean the future is broken. It simply means people are uncomfortable with the present. Markets hate uncertainty more than bad news. Clear bad news is easier to price than unknown risk. This is why markets often fall before the worst actually happens. Investors try to get ahead of risk. By the time the outcome is clear, prices have already adjusted. This is why saying, "I'll buy when things feel safe," usually means buying much higher. Fear-driven selling also creates distortions. Assets get priced as if the worst possible outcome is guaranteed, but worst-case scenarios rarely happen exactly as imagined. When reality turns out to be less severe, markets recover. This is where opportunity is created, not because things are perfect, but because expectations were too negative. Long-term investors don't wait for comfort. They wait for mispricing. Now let's apply this to crypto and XRP. Right now, many people are asking, what if this gets worse? That question is already in the price. Markets are forward-looking. They don't wait for confirmation. They react to probabilities. Could prices go lower? Yes. But the key question is not whether prices move down next week. The real question is whether the long-term value of the technology is permanently impaired. And in this case, it is not. Fear does not destroy technology. Leverage destroys portfolios. And what we are witnessing right now is leverage being removed from the system. That process is painful, but it is also healthy. It resets markets. Healthy markets are built on real demand, not borrowed money. When excess leverage is flushed out, the remaining investors are stronger, more patient, and more aligned with long-term value. Another important psychological trap is time horizon. Most fear comes from short-term thinking. People imagine what their portfolio might look like in 30 days and panic, but markets reward those who think in years, not weeks. If you zoom out, these events become much smaller. 5 or 10 years from now, no one will be talking about the Japan carry trade unwind. They will be talking about which technologies won and which ones didn't. This is why emotional discipline matters. The market's job is to test your conviction. It creates volatility to shake out weak hands. That volatility feels personal, but it isn't. It is structural. The biggest mistake investors make during these periods is assuming that fear equals truth. Fear is a reaction, not a forecast. The market does not fall because the world ends. It falls because people are afraid it might. And once that fear peaks, selling pressure slows. Liquidity stabilizes. And prices begin to reflect reality instead of imagination. Markets rarely move exactly how people expect, but they usually move within a reasonable range of outcomes. So instead of asking, is this the end of crypto? The better question is, what are the most realistic scenarios from here? The first and most obvious scenario is a slow unwind. Japan continues to raise interest rates gradually. The United States slowly lowers rates over time. Large funds continue reducing exposure, but in a controlled way. In this scenario, markets experience volatility, but not collapse. Prices move up and down, sentiment remains fragile, and fear slowly fades as uncertainty decreases. This is actually the most common outcome in financial history. Slow, uncomfortable, and boring. No sudden crash, no dramatic recovery, just time doing its job. The second scenario is a faster than expected unwind. If Japan raises rates more aggressively, some funds could be forced to sell assets more quickly. This could lead to another leg down in markets, including crypto. This is the scenario that scares people the most, but even in this case, it's important to stay grounded. A faster unwind does not mean permanent damage. It means faster price discovery. Selling happens sooner instead of later. Pain is concentrated instead of stretched out. Historically, sharp sell-offs followed by clarity often lead to faster recoveries.